before I do the main topic, I've said, let me review what you have already done in the past concerning the topic of cash flow, because you have already done this topic before. You all know that if you are required to prepare a cash flow statement for a business, you are required to classify your cash flows into 3 categories. That means that a cash flow statement has 3 sections. That means you classify all your cash flows into 3 categories. So let me review those categories first. Now, you all know that the first category of your cash flows is what we call cash flows from operating activities. As a business, you are required to identify your cash flows from operating activities. Whatever they are, let me just assume that you have identified them. You as a company, you are required to identify all your cash flows from your operating activities. Once you identify them, of course, some will be positive, some will be negative, whichever they are. You are required to get the net of all of them, get the net of all those operating activity cash flows. That net, we normally push it to the extreme. It could be a negative amount. That net amount could be either a negative or it could be a positive amount. If it's a positive amount, you remember, you used to call it net cash inflow from operating activities. If it was a positive amount, you used to call it cash flow from operating activities. If it's a negative, you used to call it net cash outflow from operating activities. Good. So I'm assuming you have identified, of course we shall come back, but I'm assuming you have identified all your cash flows from operating activities. After you have identified your cash flows from operating activities, you are required to come to the second category of cash flows, and that is cash flows from investing activities. Cash flows from investing activities. Again, go through the question and identify what are the cash flows from investing activities for that business. Again, some would be positive, some would be negative, whatever we shall find out in a short while. Good. After you have identified all your cash flows from investing activities, again, you are required to get the net amount of all of them, and whatever the net is, you push it to the extreme. Again, that net amount could either be a positive amount or it could be a negative amount, depending on whether the negatives were more than the positives or the positives were more than the negatives, depends. For now, let me assume that my negatives were more than the positive, so I got a net amount which is negative. If it's a negative amount, you remember you used to call it net cash outflow from investing activities, net cash outflow from investing activities. So that's all about the second class of cash flows. Then you used to go to the third category of cash flows, and that is what you are calling cash flows from financing activities. You have to identify your cash flows from financing activities. Whatever the cash flows are, again, you have to identify them. Again, some of them were positive, some of them were negative. After you have identified your cash flows from financing activities, you had to get the net again of all of them, and whatever is the net amount, you have to push it to the extreme. Whatever is the net. Let me assume for now again that net amount that you got was a positive amount. If it's a positive, you remember you used to call it net cash inflow from financing activities. Net cash inflow from financing activities. Good. Once you have identified the cash flows from the 3 categories, remember, you had to get the total of those 3 categories. How much is your cash flow from operating activities? Get that amount. get the cash flow from investing activities, whatever the amount you got, and get the cash flow from financing activities, whatever the amount you got. Get the net of the three figures. Get the net of the three figures, whatever the net you get. That net of the three categories, again, could either be a positive or a negative. If it's a positive, you used to call it increase in cash and cash equivalent. If it was a positive, you remember you used to call it increase in cash and cash equivalent. If it was a negative, you used to call it decrease in cash and cash equivalent. Okay? After you have identified the cash increase or decrease in cash and cash equivalent, I do hope you remember you had to come and add what you used to call opening cash and cash equivalent. You had to come and add what you call opening cash and cash equivalent, whatever it is. Listen, you all know that whenever you're given a question on cash flow, the examiner will give you the balance sheet for 2 years, one for last year and one for this year. So he'll give you two statements of financial position, which is the balance sheet, one for last year and one for this year. So we are preparing our cash flow statement for the current year, but you need the balance of the previous year. And whatever was the closing balance of the cash and cash equivalent last year, which you pick from the balance sheet last year, that's what you call the opening cash and cash equivalent. So to get this opening cash and cash equivalent, you will be required to go to the balance sheet of last year, pick whatever was the closing cash and cash equivalent that time, and bring it now as the opening this year. Good. Then whatever net you get down there, that net amount is now what you call the closing cash and cash equivalent. The closing cash and cash equivalent. And that closing cash and cash equivalent that you are getting here in the cash flow statement should be the same as the cash and cash equivalent that you are given in the balance sheet by end of this year. In other words, it's like we are using our cash flow statement to try and reconcile our cash flow balances. What was the cash flow last year and what was the cash flow this year? So the moment I got the increase in cash and cash equivalent and I added the opening cash and cash equivalent, whatever I am getting as the closing cash and cash equivalent should be the same as the balance in the balance sheet by end of this year in the balance sheet as per the cash and cash equivalent of this year. Good. So that's an overview of how you used to prepare a cash flow statement. That means you have to identify your cash flows from operating activities, identify your cash flows from financing activities, and then identify your cash flows from investing and financing. So I want us to go back now and discuss each of the categories. How do you identify your cash flows from operating? How do you identify your cash flows from financing? And how do you identify your cash flows from investing? But of course, before we discuss how to identify your cash flows from operating activities, you need to remember when we say we are looking for cash flows from operating activities, what kind of cash flows are these? When we say we are determining or we are trying to determine the cash flows from operating activities, what cash flows are these? Now, of course, you remember operating activities by definitions are those transactions and events that are used in the determination of profit. Any transaction or event that is used in the determination of profit in a business, that kind of a transaction is classified as an operating activity. So we are trying to ask ourselves, from all our operating activities, all those transactions and events that were used in the determination of profit, how much was the cash flow from them? How much was the cash flow from them? Good. Meaning therefore, listen to this now. Meaning therefore, if I take my profit and loss, let me assume that your company prepared your profit and loss. I want to assume it is in a T format. It's in a T format. This is profit and loss. You all know that expenses are normally debited in the P&L account. And you all know revenues and incomes are always credited in the P&L account. This is incomes and revenues. These are expenses, whatever it is. Then we normally get the net of the two. We normally get the net of the two to represent the net profit. When you compare the incomes and you net against the expenses, what you get is the net profit. So whatever is the balance here, we call it net profit. And let me assume that your company got a net profit of 100 million. When you got the net of the incomes and you offset the expenses, you remained with a net profit of 100 million. So in principle, now listen to this now. In principle, it means, in principle, not the true. In principle, it means that our net cash inflow from operating activities should be these 100 million. In principle. Why? Because these are the inflows of the operating activities and these are the outflows of the operating activities. So when you get the net of the two, in principle, therefore, your net profit should represent your net cash inflow from operating activities. But the question is this: is it true that 100 million profit before tax is the actual net cash inflow from operating activities? The answer is no. That 100 million, though it is your true profit as a business, yes, it is the profit that you determined using the normal accounting principles and concepts. But in terms of cash flows, is it the true net cash inflow? It would have been the true profit. Listen, it would have been the true cash flow. The 100 million would have been the true cash flow if everything in the income statement, either on the debit of the income statement or on the credit of the income statement, if everything in the income statement was by cash, then it would be obvious that this 100 million would represent the net cash inflow. If all the items in the P&L account were by cash, then it would imply that your net cash inflow as a business from your operating activities would be 100 million. But we are going on to say that is not true. Why? Because it is obvious that when you are preparing your cash flow statement, your P&L account, we don't use the cash basis of preparation. We normally use what we call the accrual basis of preparing our financial statements. And therefore, this 100 million profit that we are given or you are getting is not the true profit if everything in the P&L account was by cash flow, was by cash. But don't forget, we are trying to determine the cash flows from operating activities. You all know there are some items you could have either debited in your P&L account or credited in your P&L account, which automatically they are not cash items. They are items that are normally debited in the P&L account or credited in the P&L account, which are not by cash. So to determine the true profit, listen, to determine the true profit, if everything was by cash, then, in other words, to determine the cash flows from operating activities, then we normally pick that profit before tax. We normally pick that profit before tax that you are given in the income statement, which in our case here is 100 million, and listen, and adjust it with the few items that went to the income statement which are not by cash. Let me give you an example. When you are doing your income statement, you normally debit your profit and loss account with an expense we normally call depreciation, whether it's depreciation of machinery or motor vehicle or furniture and so on. So let us assume that you debited your P&L account this year with an amount of depreciation of 5 million for motor vehicle or whatever. Then you got this profit of 100 million. But don't forget, we are trying to ask ourselves, what would have been the true profit if everything in the P&L account was by cash? So that we get what we are calling the net cash inflow from operating activities. I have said, if everything in the P&L account was by cash, then the true net cash inflow from operating activity would have been 100 million, meaning we would not have even determined it. But we are saying that 100 million is not the true net cash inflow from operating activities. Why? Because there are some items that could have either been debited in the P&L account or credited in the P&L account, which are what we can call non-cash items. Therefore, to determine the cash flow from operating activities, we normally pick that 100 million profit, then adjust it with those few items that went to the P&L account which are not by cash. So that we ask ourselves, this particular item, for example, depreciation, if it was not in the P&L account, would our profit have been more than 100 million or less than 100 million? Then if the profit would have been more than 100 million, then we correct that profit by adding back that depreciation. Or if it has made a profit more than it should be, we deduct. So we are trying to adjust this profit using the few items that went to the income statement, which are non-cash items. Good. So when you are preparing your cash flow statement, we normally start by picking the profit before tax. That one the examiner will always give you. Don't forget that whenever you're given a question on cash flow, the examiner will give you an income statement and two balance sheets, one for last year and one for this year. So just go to the income statement that the examiner has given to you, pick your profit before tax. Then go through the question and find out, are there non-cash items as per the question which were debited either in the P&L account or credited in the P&L account? So we use this profit and adjust it with those few non-cash items. I've already identified one called depreciation. So we want to ask ourselves, if depreciation was not in the P&L account, what profit would we have made? Is it more than 100 or less than 100? Now, of course, you know, depreciation is an expense. So when we included 5 million as depreciation in the P&L account, then listen, from the cash point of view, our expenses were overcasted. From the cash point of view, I'm not talking from the profit point of view. From the cash point of view, you remember you have included depreciation of 5 million in the P&L account, and therefore your expenses are more. As far as cash is concerned, your expenses are more than they should be. So when we say that our expenses are overcasted, then we need to ask ourselves, when expenses are overcasted, was my profit undercasted or overcasted? It is obvious when expenses are overcasted, your profit was obviously undercasted. When expenses are overcasted, profit is undercasted. So to correct this 100 million profit, we would come back and now add that depreciation of 5 million so that we actually get and ask ourselves the true profit. If that depreciation was not there, the true profit would have been more. Don't forget, we are trying to determine the true profit if everything in the P&L account was by cash. That true profit, if everything in the P&L account was by cash, that profit is what we would have called down here the net cash inflow from operating activity. Good. Let me give you another example. During the year, you as a company, you had to impair your goodwill. For example, you had an asset called goodwill and you impaired that goodwill. So that impairment charge for the year for goodwill is what you must have debited your P&L account with. When you debited P&L account with that impairment, did you actually pay cash for it? The answer is no. That means that impairment loss on goodwill is another non-cash item. So again, you ask yourself, what effect did it have on the profit from the cash point of view? What effect did it have on profit from cash point of view? Again, you will argue by saying our expenses would be overcasted. When expenses are overcasted, again, automatically our profit is undercasted. So you come and add back that impairment. Good. Now, it is obvious now, I hope you can remember, many more others. Listen to this now. I want to give you a question. What are the other non-cash items that normally go to the P&L account, which, give me some more, other non-cash items, which normally go to the P&L account and yet they are not cash items? So give me a few more non-cash items. Give me a few more non-cash items. I have identified two, that those are things that went to the P&L account, yet you never paid anything for them. So I use those items and try and adjust the profit. So I want you to tell me, what are some of the other items that you can remember, because I'm reminding you. Good. Somebody has already given me two more. One of them is bad debts. Let me explain it. When a debtor becomes a bad debtor, when a debtor becomes bankrupt or he can't pay you, you have to write him off. How do you write him off? You normally credit debtors and you debit the account called bad debts. That amount of the bad debts, you will debit it in the profit and loss. When you debited P&L account with the amount called bad debts, did we actually pay the money for that bad debt? The answer is no. It's just a bookkeeping entry. This customer was declared bankrupt. He can't pay us. We have to write him off. And therefore, the rule says, when you write off a bad debtor, consider that as a loss in the P&L account. So what you did, you wrote off that bad debt. Good. So you came and said, yeah, bad debts is another one. So you debited P&L account. Again, it's an expense. Did you pay anything for it? The answer is no. It's just a bookkeeping entry. So what do? You come and add that bad debts. Good. Another one somebody has given us is the amount we are calling provision for bad debts. Provision. They are different from bad debts. Listen, when you anticipate as a business that your debtors are likely not to pay you, when you anticipate that some of your debtors are likely not to pay you, then as a company, you are required to provide or to make a provision for that loss. When you anticipate that some of the debtors are likely not to pay you, you are required by the accounting principle called prudence concept that you provide for that loss. So assuming as a company you made a provision and you anticipated that some of your debtors are likely not to pay you, so you made that provision. You anticipated a loss from those debtors. So you made a provision for bad debts. Again, you must have debited P&L account. Good. When you debited P&L account, again, it's an expense which was non-cash, and of course again is another non-cash expense. So from the cash point of view, our expenses are overcasted. So you come and correct that by adding, you come and add that provision for bad debts, provision for bad debts. Somebody has given me another one called amortization. Good. Amortization, when you have an intangible asset, let's call it trademark or patent or copyrights, and therefore when you depreciate such intangible assets, we don't call that depreciation. We call depreciation for tangible items, but for non-cash items, for intangible item, we call it amortization. So the concept is the same as depreciation. It's only that for intangible assets like patents, trademarks, copyrights, we don't call them depreciation, we call them amortization. So it's the same as depreciation. Again, you must have debited P&L account, and obviously there was no expense by cash for that. You come and add. Good. So you come and add amortization. Good. Amortization. Good. Somebody has given me another one, and that is loss or gain on disposal. Let me explain. Let me explain that one. As a business, you had a motor vehicle which had a net book value of, let's say, 10 million. If you sold it for cash of 8 million, then you sold it at a loss of 2 million. You sold a motor vehicle whose book value was 10 million and you sold it for 8 million. As a business, you made a loss of 2 million. That loss of 2 million, being the loss on disposal, you must have debited it in the P&L account. You must have debited it in the P&L account. But is it something you paid for? No. It's just another non-cash item. It's just a bookkeeping entry that you made. But you debited P&L account with that loss on disposal. Again, it's an expense. From the cash point of view, your expenses were overcasted. When expenses are overcasted, your profit was undercasted. So to correct that profit, you come and add that loss on disposal. That loss on disposal. Good. The same, assuming you had that motor vehicle, which had a book value of 10 million, you sold it for, let us now assume you sold it for 12 million. You now sold it for 12 million. If you sold it for 12 million, then you must have made a gain on disposal of 2 million. That gain on disposal of 2 million, you must have credited it in the P&L account here, and you considered it as a gain on disposal, 2 million. But is it something you received? No. Remember, you received 12 million. But the gain of 2 million is just a bookkeeping entry that you made in the income statement. So it's not something you received. No, what you received was 12 million cash, but the 2 million you took to the P&L account is just a bookkeeping entry. So that gain on disposal again, from the cash point of view, listen, from the cash point of view, again, it overcasted your incomes. It overcasted your incomes, and therefore it overcasted your profit. So if it is a gain on disposal, it made your profit more than it should be. Don't forget, we are trying to look for the true profit in the P&L account if everything in the P&L account was by cash. Good. So we are saying if it's a gain on disposal, you less. If it's a gain on disposal, you less. This is gain on disposal. Gain on disposal, you minus. Good. Now, somebody has given us another one, and that is what we are calling loss. No, revaluation loss. Now, this is somebody called Patty. I want you to listen carefully. I want you to listen carefully because most students confuse that and give us that as an non-cash item. Listen, Patty. You are called Patty. I want you to listen carefully because I want to explain to you. Listen now. Listen. As much as it's true, revaluation loss is a non-cash item. Listen. Or it could be a revaluation gain. Whenever you have an asset, let's call it land, and I want to assume you had land whose book value by the beginning of the year was 100 million. Assuming during the year, you as a company, you revalued your land upwards by an extra 20 million. So you must have debited land by 20 million. You must have credited an account called revaluation reserve. You debited land and you credited this account called revaluation reserve by 20 million. And you came and said, dear land, listen, then come the end of the year, you had to close the books. This balance called revaluation reserve, you took that balance to the balance sheet as a component of equity. The 20 million, you took it to the balance sheet as a component of equity. Now listen. So when you revalued this land by 20 million, you debited the land by 20 million, you credited revaluation reserve by 20 million. Listen, is that a non-cash item? Yes. Is it a non-cash item? Yes. But, listen, but the rule of accounting did not say that you debit asset and you credit P&L. No. The rule did not say you debit the asset, you credit P&L. No. The rule of accounting says when you revalue a fixed asset, you debit the asset and you credit revaluation reserve. Then that revaluation reserve will go to the balance sheet as a component of equity. So the revaluation reserve, though it's an non-cash item, it doesn't go through P&L. It could be you revalued your land downwards. So you must have credited the land by 20 million. You must have debited revaluation reserve by 20 million if you revalued it downwards. But you did not credit the asset. Listen, we did not credit the asset with the 20 million and debit P&L account by 20 million loss. No. The rule says when you revalue an asset downwards, go credit the asset and you debit revaluation reserve with that revaluation loss. Then again, that revaluation loss goes to the balance sheet as a component of equity. Listen, so as much as it's true that this revaluation loss is a non-cash item, the point is, listen to this now, the point is it affecting what we are trying to adjust? Don't forget, we are trying to adjust this profit before tax. I told you operating activities are those transactions and events that are used in the determination of profit. Operating activities are those transactions and events that are used in the determination of profit. So as much as that revaluation loss is a non-cash item, listen, we did not debit it in the P&L account here, 20 million, no. Instead, you credited the asset and you debited revaluation reserve account with that loss. Then that loss goes to the balance sheet direct as a component of equity. Or it could have been a gain. It could be a revaluation gain. You debited the asset and you credited revaluation reserve. You did not credit P&L account. Listen, so as much as it's true, revaluation loss or revaluation gain are non-cash items, listen, they do not appear, listen to this, they do not appear in your cash flow statement as a non-cash item. Are you okay, Patty? Why don't they appear in the cash flow? Because they did not affect your 100 million profit. You took them direct to the balance sheet. But we are trying to adjust the true profit so that we get the true profit if everything in the P&L account was by cash. So I hope you now know, Patty, why we should not use the revaluation loss as an non-cash item. As much as it's true, it's a non-cash. The point is it affecting what we are trying to adjust? The answer is no. It did not affect the profit which we are trying to adjust, because we are trying to determine the operating activities, those transactions and events that are used in the determination of profit. Good. Now, I hope, you have said you have understood. Thank you, Patty. You have said you have understood now. Bye. Listen. There is one more item. Listen. There is one more non-cash item which you have not given me, but you will always get it in the question. In any question you have ever done or you will ever do, you will always find this other non-cash item. Listen. In other words, whenever you are given a question of cash flow, there are two non-cash items that will never miss in that question. Two non-cash items that will never miss. One of them being depreciation. Depreciation will never miss. I'm not saying that the examiner will give it to you. There are some questions you have to calculate the amount of the charge for the year. There are some questions they give you, but you have either way to get it. Okay? Whether it's given or you have to calculate it. But I'm saying there are two non-cash items which will never miss in any question that you will do in the future or you have done before. Yet you have not given me that other one. These others you have given me: impairment, provision for bad debts, amortization, loss on disposal, gain on disposal. It's not a must for them to be there in a question. It is that some questions have them, some don't have them. But there's another non-cash item which is a must find in any question that you will do or you will ever do. Okay, somebody has already given it to me. And that is somebody called Akiro Lucia. Okay, fine. Fine. So let me explain it, and I want you to listen carefully. I want to explain it. So give me a minute. I explain it. I want to explain the other one that I was mentioning. Just a minute. Something is wrong. Give me a minute. Give me a minute. Just give me a minute. There's something. Okay. Where is this? Just a minute. There's something wrong somewhere. Okay, I think we can now continue. So let me explain. That is who he has given us finance cost. But before I give you the discussion of it, let me take you through a question again. Listen. When you did financial accounting, you must have done a topic called company accounts. In that topic of company accounts, the examiner always used to give you a trial balance. In a topic of company accounts, the examiner always used to give you a trial balance. In that trial balance, he would give you something like this: a 10% debenture amounting to something like 500,000. In that trial balance, he would give you what we call interest on debentures. Let us assume 40,000. Okay? Now, when you're given a trial balance of this nature, and you are required to prepare a P&L account, I want you to tell me how much were you charging in the P&L account as interest. When you are given a trial balance of that nature, you are a company, you are required to prepare your financial statements, and in your trial balance you have a 10% debenture, and in that trial balance there is 10% debenture worth 500, and then you have interest on debenture. When the examiner used to require you to prepare an income statement or a profit and loss, how much were you charging in the P&L account as interest? Somebody now? Assuming you are given this as your trial balance. Somebody has given me 50,000. Another opinion. Let me hear. Somebody has given me 50,000. Another opinion. Somebody else. A second opinion. I'm not saying he's right. I'm not saying he's wrong. Good. 2 people have given me 50,000. Good. Now listen. Let me explain. Now, when you are required to prepare a P&L account, you as a company will normally follow a concept we call accrual concept. You all know what that accrual concept states. It states that costs should be recognized when they are incurred, but not when they are paid. When you are required to prepare financial statements, we normally follow the concept called accrual concept. And the accrual concept states you recognize costs when they are incurred, but not when money is paid. So when you are preparing the income statement for this company, when you are preparing the income statement, it doesn't matter. Listen, it doesn't matter whether you are paid interest or not. You recognize cost when it is incurred, but not when it is paid. So according to this trial balance, the company has a 10% debenture. So it means every year they are supposed to pay their debenture holders an interest at the rate of 10%. So 10% of 500,000, that comes to 50,000. So every year they're supposed to pay their debenture holders an interest of 50,000. That becomes the charge for the year. The charge for the year. And so when you are preparing the income statement for this company, you will get the charge for the year. How much was incurred? That is the charge. And the amount incurred is 50,000. That's what you debit in the P&L account. Listen. It is only when you are doing the balance sheet of this company, that's when you become concerned. Listen, when you're doing the balance sheet for the company, that's when you get concerned as to whether you owe the debenture holders anything. That's the time you now go back to the trial balance and check, have we paid our debenture holders anything? So according to this trial balance, we have paid them 40. So it means because I was supposed to pay them 50 and I've only paid them 40, then it means by the end of the year, as a company, we owe our debenture holders an amount of 10,000. So that 10,000 will go to your balance sheet as a current liability in the name of interest owing of 10,000. So that's how the 10,000 will affect the balance sheet, and the 50,000. Listen to this now. So when I'm doing a cash flow for this company, I'll go to their P&L account and I'll see they have charged how much in the P&L account? 50,000 as interest. But is it true that they paid 50,000? No. What they paid is 40,000. So 50,000 was just a bookkeeping entry. It was just a bookkeeping entry. Otherwise, the actual interest paid was 50. Listen. So it means, therefore, when I'm doing a cash flow for this company, I'll come and ask myself, this guy's debited P&L account by 50 as interest, or what you can call finance cost, 50. But is it true they paid 50? The answer is no. They paid only 40. So it means that 50 is a non-cash item. Then again, I ask myself, what effect did it have on the profit? The 50, what effect did it have on the profit? Again, our expenses were overcasted. When expenses are overcasted, automatically profit is undercasted. So with that 50, which is the finance cost, you will now come and again add back. Why? Because it undercasted your profit, you add back. Listen to this carefully. Listen carefully. But remember, we paid 40. Remember, we paid 40. I have already told you there are three sections of the cash flow statement. There is the operating section, there is the investing section, and there is a financing section. Now, in that section we called cash flows from financing activities. Cash flow from financing activities. Listen, among the financing activities, don't forget, financing activities are those transactions that affect finances. For example, when you issue shares, that's part of finances. When you raise finances by issuing debentures, that's part of finances. Now, whenever you pay returns, listen, whenever you pay returns to the financiers, whenever you pay returns to the financiers of the business, the repayment or returns to the financiers, those returns are normally considered as part of financing. For example, when you pay the shareholders their dividend, dividends paid is classified as financing activity. We pay debentures their cost of borrowing, that is debenture interest. So whatever interest you paid this year, listen, whatever interest you paid this year, that will go to the cash flow statement as part of the financing activities, where we come and now say your interest paid. And according to this question, you paid 40. That will be part of the financing activity, the whatever amount you actually paid. Listen, but among the non-cash items in the cash flow, there is that charge for the year, which in our illustration is 50, which you never paid. It's just a bookkeeping entry. So I hope you're getting that whatever is the finance cost or the charge for the year, that must be considered as a non-cash item. But whatever you actually paid as interest, that is classified as a financing activity item. Good. Listen. So let me change the trial balance. Let me change the trial balance. Suppose you are given a trial balance of this nature, again, which it was possible. In that trial balance, you are given a 10% debenture. You are given a 10% debenture. And in that trial balance, there is nothing like interest. There is nothing like interest. Then you are required to prepare P&L account for the company. Why are you still charging interest in the P&L account? The answer is obviously yes. Why? Because we are following this concept we are calling what? The accrual concept. You recognize cost when it is incurred, but not when money is paid. So, according to this trial balance, I'm supposed to pay my debenture holders interest at 10%. 10% of 500 is 50. Whether I paid it or not, that's not the concern of the P&L account. No, you charge it, that 50. When I'm doing the balance sheet, listen, I'll go back now to the trial balance and ask myself, according to this trial balance, have we paid our debenture holders anything? The answer is no. We have paid them nothing as per the trial balance. So it means, listen, it means as a company, we owe them the whole 50 also. We owe them the amount of the 50,000. So that 50,000 became the charge for the year, and that 50,000 became the liability also. Now listen. So when I'm doing the cash flow for this case number 2 now, I'll go to the income statement. I see a charge of 50 in the P&L account as interest. It's just a bookkeeping entry. It was just determined by taking 10% of their debenture. That's 50. So it's obvious that 50 is a non-cash item. Good. Now listen. What about among the financing activities? Will there be interest paid this time? Listen. Will there be interest paid this time? The answer is no. Why? Because you paid nothing. So in your financing activities now, there will be no interest paid. Why? Because you paid nothing. So the whole 50 became the charge for the year. The whole 50 became a liability for the year. Therefore, you never paid anything. And so in your cash flow statement, there will be nothing like interest paid among the financing activities. Among the financing activities. Good. So I hope you have understood that whatever is the interest charge for the year, whatever is the interest charge for the year, that is normally considered as a non-cash item. Good. I've also said, in any question you will do, all you have done, two non-cash items will never miss. One is depreciation, and two, the finance cost. Listen. So it is obvious, therefore, that whenever I'm given a question on cash flow, there are three things that you should never miss among the operating items. There are three ticks you should never miss. One is your profit before tax. Why should you lose that mark? And yet, you just go pick it from the P&L account the examiner has given to you, pick that a profit before tax. Depreciation is another one. It will never miss. There are some questions that will give you the charge for the year. There are some questions that may require you calculate. 3, finance cost. Listen, this one you don't need to calculate it. It will be given to you in the income statement. So just go pick it. Otherwise, for the other non-cash items like impairment, amortization, loss on disposal, gain on disposal, those ones depend on the question. But depreciation, I've told you, and finance cost will never miss in any question. Good. So for now, listen, for now, let me assume that those were the only non-cash items in the P&L for now. So once you do that, you get the net. From the profit before tax, you have adjusted all those non-cash items, whatever they are. Once you adjust, whatever total you have got down there, that is what you call cash flow before. We call it cash flow before working capital changes. We call it cash flow before working capital changes. Then you now go and bring in the working capital items now. You go bring in the working capital items. Of course, you know working capital items include current assets and current liability items. We are trying to say cash flow before working capital changes. So you'll go to the balance sheet last year, compare what was the stock last year with the stock this year. That's a working capital item. Then you come and say, for example, maybe there was an increase in stocks. Then you have to ask yourself whether it's a positive or a negative. In other words, an inflow or an outflow. It's obvious. When stocks go up, last year we had stocks of 5 million. This year we had stocks of 10 million. Our stocks going up, we must have purchased some more stocks. That's an outflow. Okay. Then after stocks, you go to the next current asset. Normally it's debtors. Okay. Debtors, let me assume debtors last year was 2 million. This year the debtors are 1 million. Meaning the debtors are going down. So if there was a decrease in debtors, or some questions will call them trade receivables, whatever they are calling them, whether debtors or trade receivables, whatever it is. So I'm saying, if debtors are going down, what could have happened? It is obvious those customers must have paid us. So as a business, we must have received that amount. That's an inflow. Good. Listen. After debtors, among the current assets, we normally have cash and bank. Listen, I hope you remember, we normally don't analyze cash and bank as a working capital item here. As much as it's true, it's a working capital item in the balance sheet, we normally don't analyze it together with stocks and debtors. Why? Because cash and cash equivalents, they have their actual place in the cash flow statement. They have their actual place in the cash flow statement. You remember I told you that after you have got the totals of the three categories, operating, investing, and financing, I told you get the net of those three, and I told you call it increase in cash and cash equivalent. Then I said you come and add the opening cash and cash equivalent. You add the opening cash and cash equivalent so that you get the closing cash and cash equivalent. So down there, that's where you will now bring in the cash. When you will be adding that opening cash and cash equivalent, you now go to the balance sheet of last year and pick it. And you now add it here, the opening cash and cash equivalent. So for cash, it has its own place. Whether it's cash or bank balance is the same. Good. So we normally don't analyze cash among the working capital? No. As much as it's true, it's a working capital item. Good. So among the current assets, listen, among the current assets, I'm assuming I'm through. You have analyzed the stocks, you have analyzed the debtors. I've told you I've left the cash and bank. Then you go to the current liabilities. They are part of working capitals. Let me assume the only current liability as per your question, the only current liability as per your question I want to assume is creditors. Maybe the creditors last year was 7 million. This year the creditors are 5 million, meaning they have gone down. Let me assume that there was decrease in creditors, whether they are calling it creditors or trade payables, whatever it is. Then you ask yourself, for creditors to go down, what must have happened? For creditors to go down, we must have paid them. As a business, we must have paid them. That is obviously an outflow. Good. After you have done that, I'm assuming it's the only working capital item among the current liabilities, get the net. Once you get the net, you come and minus, I hope you still remember, you come and minus what we call the tax paid. Once you minus the tax paid, you get the net. Listen, you get the net and you push it now to the extreme. You now push it to the extreme. That net is what I was saying will either be the net cash inflow or it will be the net cash outflow from operating activities, depending on whether it's a positive or a negative amount. Let me assume it's a positive. We call it now net cash inflow from operating, net cash inflow from operating activities. Net cash inflow from operating activities. Good. Once you are through with this first category, because we are through with the first category, now we go to the second categories of the cash flows. So I hope now you know how to determine the cash flow from operating activities. Listen, it is the most critical section of the cash flow. Otherwise, the remaining two are not so critical as this first category. Otherwise, the main category is always how to determine the cash flow from operating activities. So it's a next section of the cash flow that you should understand. Good. So let's now go to the second category of the cash flows. And now that's what we are calling cash flows from investing activities. Cash flows from investing activities. Again, we need to ask ourselves, what are investing activities? What are investing activities? Listen. Investing activities are those transactions and events that affect fixed assets. Any transaction and events in your business that affected a fixed asset, that transaction should be classified as an investing activity. For example, during the year you could have purchased a more motor vehicle or purchased land or purchased building. It's a transaction that affected a fixed asset. So one of the examples we can give here is purchase of fixed assets. By whatever the amount, it is obvious you purchased, so you paid cash. That is an outflow. Listen, it could also be you sold a motor vehicle or you sold furniture. Whatever you received from the sale of that motor vehicle, bring it. Come and say a sale of a vehicle, fixed asset, whatever it is. That is something you received. That's an inflow. Good. Let me give you another one. Listen, you go to the balance sheet. Among the fixed assets in the balance sheet, you normally have something like land, maybe motor vehicle. Then let me assume this is 2021 or 2022 and maybe 2023 year, whatever it is. Then you are given investments, 5 million, 6 million. Now listen, again, investment is in the balance sheet as a fixed asset. So if our investments last year were 5 million and our investments this year are 6 million, then you could have purchased some more investments. So even investments that are in the balance sheet as a long-term asset or an non-current asset, that should also be considered as an investing activity. So maybe we come and say a purchase of investments. Purchase of investments, whatever it is. Listen carefully. Those investments that you have gave you a dividend this year, or you earned an income from your investment. It could be investments that you had a fixed deposit, or maybe you bought some treasury bonds, it's an investment, or you bought shares in another company, it's an investment, and they gave you some income. Listen, any income you are receiving from an investment, which is a long-term investment, that income should not be considered as an operating activity. Get the point here? Investment income, if the investment is a long-term asset or an non-current asset in the balance sheet, the investment income from that investment is always classified as an investing activity. So any investment income should be considered as an investing activity. You are receiving an income from one of your fixed assets, which is an investment. So any investment income, don't forget and consider it as operating. No, we consider it as an investing activity. If you bought an investment and you have some investments, those investments are giving you an investment income, then we consider it as an investing activity. That's important, that any investment income should be considered as an investing activity. Good. So for now, let me assume those are the only ones among the investing activities. Okay? Good. Now, I've said investing activities. Just to remind you, investing activities are those transactions and events that affect any fixed asset. You're buying motor vehicle, selling motor vehicle, buying furniture, selling furniture, buying land, selling land, buying investments, or even selling investments, so long as they are fixed assets. Then I've said, important thing there is, if you are receiving an income from your investment, that investment income should be considered as an investing activity. Good. So let me assume those are the only ones. There are normally not many in a question. Get the net, push it to the extreme. Get the net, push it to the extreme. Again, that net could be either positive or negative. Let me assume now our negatives were more than the positives. So we had a negative net amount. That will give you what we are calling net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. Or if it's a positive, you would have called it net cash inflow from investing activities. Ours, we are assuming it's a negative, it becomes net cash outflow from investing activities. Then we now go to the last category, and that is cash flow from financing activities. Cash flow from financing activities. We go to the last category, cash flow from financing activities. Of course, I've already said something about it, and I told you, in financing activities are those transactions that affect finances. Any transaction that affects finances of a company should be classified as a financing activity. For example, you as a company wanted to raise more finances, you issued shares. So issue of shares becomes an example of financing activity. Whatever you received from your issue of shares this year, whatever it is, good. Maybe again, as a company wanted to raise more finances, so you had to issue some debentures. So maybe you had to issue some debentures, issue of debentures, whatever it is, you received whatever you received. Obviously, that's an inflow. Listen, maybe as a company, you had a loan, and the loan last year was 5 million. The loan this year is 2 million. For the loan to have gone down, you must have repaid. Loan is part of financing. Maybe you came and said, dear, loan repaid. Loan repayment. That's obviously an outflow. That's an outflow. Listen. Those being the major finances, I'm assuming from a question, those being the major finances, listen, you have to ask yourself from this question, are there any returns that we are paying to these financiers? Are there any returns we are paying to these financiers? Maybe yes. One form of return we are paying to them is dividend. To the shareholders, we normally pay them dividend. So dividends paid is part of financing. Dividends paid is part of financing. Listen, to the loan providers and to the debenture holders, what do we pay them? We normally pay them interest. So interest paid is also considered as part of financing. Interest paid. Now listen. Listen carefully. You may take a book, and in that book, you realize that the interest the company paid, listen, is considered as part of the operating here. Among the tax paid here, together with the tax paid, listen carefully, together with the tax paid here, you may find some questions bringing here, or some books bring here interest paid. Not interest charged, interest paid to be together with the tax paid. It's allowed. The accounting standard on cash flow, which is IAS number 7, IAS number 7 allows interest to be treated as either part of the operating or as a financing. Listen, and I'm not talking of the interest charge, the finance cost of the 50. No, I'm talking of the interest paid. Whatever you paid, you are allowed by the accounting standard to take it as either part of the financing, meaning you take it together with, as part of the operating, you take it together with the tax paid, or you can take it purely as a financing activity. Most books consider it as financing. Why? Because it's part of the financials. You are paying a return to the financials. The financials could be the loan providers, maybe the bank, or it could be the debenture holders. You are paying them interest. Good. Funds. Once you do that, let me assume those are the only ones. Once you do that, you get the net of all of them, of all the financing activity items, push it to the extreme. Push it to the extreme. Good. Once you get the net amount, let me assume it's a positive. You call it now net cash inflow from financing activities. Net cash inflow from financing activities. Good. Then once you have identified the three categories, I hope you remember, once you have identified the three categories, I told you, get the net of all the three categories. Get the net of the three categories. That is the operating, the investing, and the financing. Get the net of the three, whatever you will get here. That net, I told you, will either be a positive or a negative. I said if it's a positive, you call it increase in cash and cash equivalent. Increase in cash and cash equivalent. Alternatively, if it's a negative, you will call it decrease in cash and cash equivalent. Then I said you now come and add what you are calling opening cash and cash equivalent. Opening cash and cash equivalent, where I told you, you will go and pick it from the balance sheet last year. You go and pick it from the balance sheet last year that the examiner will give you. Pick it there. Then what you get down here should be what we are calling closing cash and cash equivalent. Closing cash and cash equivalent. Listen, and I've told you, whatever is the closing cash and cash equivalent must be the same as the amount you're given in the balance sheet. Whatever you're getting down here in the cash flow should be the same as what you're given in the balance sheet, because the two must reconcile. Listen. So again, listen to you. Listen carefully. So again, in an exam, if you are told you have 10 minutes remaining and you have a whole question of cash flow to do, do you now start by doing the question on a logical way? The answer is no. You don't go and do it step by step the way we normally do it when you have enough time. You can feed in, listen, you can feed in the obvious items so that you at least get some marks. I've already told you some of the items. Let me assume you have read the question. Not all these items do you need to calculate them. Some are obvious, okay? Some are obvious. Like I've already told you, from the operating activities, what are the obvious ones? Profit before tax. So just come and tell the examiner, cash flow from operating activity, profit before tax, 100 million. You pick it from the income statement. Depreciation, maybe the question has given it to you. You are told somewhere as a note, during the year, the depreciation charge for the year was 2 million. You know it. Then from the same income statement, you can see finance costs. Pick it. The others that you are not given, leave them, which means you have to calculate. Okay? Leave them. But if you see from the question, I'm hoping you have read the question, you see from the additional information during the year, the bad debts of 2 million was written off. That's obvious and cash item. Listen. Then from the additional information, you can see during the year, the company sold a motor vehicle for 2 million. That's of course at financing and investing activities. Good. So listen, what I'm trying to say is this, that when you are given a question and you realize you have no time to finish it logically, pick the obvious ones. You can leave some space in between. Maybe you have identified your cash flows from operating. You have identified a few. Leave some space. Come and say down there, cash flow from investing. Okay? One of them which is obvious, you have seen from the question, is sale of motor vehicle 2 million. So why put it, not put it there? Put it there and come and say sale of motor vehicle 2 million. Then from there, you realize financing. Maybe you are told during the year the company issued shares for 2 million or whatever. Okay? Then, listen to this now. There are some obvious, like this one. Opening cash and cash equivalent. That's an obvious one. Why should you miss it? Just go and pick it from the balance sheet last year. Even though you have not determined the amount called increase in cash and cash equivalent, why should you lose this mark for opening cash and cash equivalent? Why should you lose it? Obvious. Listen to this. Obvious. Even the closing cash and cash equivalent, you can pick it from the balance sheet. Put it here. You have not got it from the cash flow, but it should be the right one. Why not put it there? Andika tu hapo closing cash and cash equivalent. You have not done it. So there are some marks you should never miss whenever you are given a question on cash flow, because they are obvious entries. The examiner will not refuse to mark your answer just because he's seeing some gaps in between, that you have not finished the operating items, you have jumped to investing, then you have left some space, you have jumped to financing, then it's like you're trying to finish the cash flow. The examiner will still mark what you have given him. He will not say that you have not prepared the cash flow in a sequence manner. No, he will mark exactly what you have given him. So don't lose the obvious marks by not feeding in the obvious. I'm assuming you have read the question. There are some which you can pick from the question, whether from the addition or from the income statement. Pick those which are obvious. Put them where they belong. Put them where they belong. Then if you still remain with time, then you can now start calculating the others. You can start calculating the others. Maybe you have sold an asset and you don't know whether it's a gain or loss on disposal. It has to be calculated. That gain or loss on disposal has to be calculated. Then if you still have time, compare the increase or decrease in cash and cash equivalent, increase in stocks, decrease in stocks, and so on. Those ones you can do them using some calculator, okay? But there's some which are obvious. Good. Now, before I proceed, I want to ask you a question. And this is something you should have done, because I've said this is not the first time you are doing a question on cash flow. We have already said among your investing activities, this is 2022, 2023. Among your fixed assets, you have investments. I said 5 million, 6 million. Now listen, among your current assets, where you had stocks, debtors, you also have investments. Maybe 2 million, 1 million, or 3 million. Or let's call it 5 million. Question is this. Listen, I've already discussed how you are treating the the investment among the fixed assets. I told you, any transaction affecting a fixed asset is an investing activity. But my question is, how are you treating any investment which is among the current assets? Any investment among the current assets, how are you treating it when it comes to cash flow? Any investment which is among the current assets. Somebody talk about that in a short while. Somebody talk about it in a short while. How are you treating any investment among the current assets? Yes, somebody chat. How are you treating any investment which is among the current assets? Yes. Not financing. Financing activities are those items that affect finances. Finances are items among the equities and capitals in the balance sheet. So when you have an investment among the current assets, it's not financing. Financing will affect equities and capitals and liabilities like loans, debentures, and so on. No. Somebody else has said working capital changes. No. Wow. Wow. You have done this before. So how are you treating this? Now listen. Some books will not call it investment. Some books will call it short-term. Ideally, it's a short-term investment. It's a short-term investment. Some books will call it fair value investment. Even for the fixed asset one, you may be given what we call fair value investment. Or investment at fair value. Investment at fair value. So both of them could be investments at fair value. Or fair value investment. But one of them is a short-term investment. The other one was a long-term investment. I've already discussed how to treat the long-term investment. What about short-term investments? How are you accounting for it? Somebody has said financing. We have said no. Somebody has said working capital items. No. Yes. Somebody else? Try and remember. Somebody else, try and remember. Try and remember before I remind you. Somebody else to attempt. Oh, okay, sawa. Now listen. Now, these are short-term investments. Some books will call them deposits, bank deposits. Or maybe you could have bought some treasury bills. Those are short-term investments. If you buy treasury bonds, that's a long-term investment. But if your company bought a treasury bill, that's a short-term investment. Or maybe you put your money in a fixed deposit for 3 months, 6 months, that's a short-term investment. Now listen. Now, among the current asset items, I've said there is normally debtors, stocks, debtors, investments, maybe those for whatever, and cash, maybe 4 million. Now listen. When I was discussing here and saying opening cash and cash equivalent, opening cash and cash equivalent, we want to ask ourselves, what is a cash equivalent? We have just said opening cash. Cash and bank are synonymous. But the question is, what is this cash equivalent? Now, any investment, now listen to this, any investment that is given among the current assets, not among the fixed assets, among the current assets, that is what we call or we classify as a cash equivalent. It is an asset that can easily be turned into cash within a short time. So for example, if you put your money in a fixed deposit account for 6 months, and after 2 months you need your money back, you still get back your money. What you only lose is the interest that the investment had earned. So you put the money in a fixed deposit account for 2 months, 3 months, and maybe after 1 week, you feel you need your money, your money back, the bank will give you back your money. What you only forfeit is the interest. So it's that kind of an asset that can easily be turned into cash within a short period of time. That's what we classify as a cash equivalent. Now listen. So any short-term investment in the current assets, any short-term investment among the current asset, that short-term investment, by whatever name they are calling it, whether they are calling it fair value investment, whether they are calling it bank deposit, whether they are calling it treasury bills, those short-term investments should be classified as part of cash equivalent. So it means, listen, when I come to this balance sheet, and I want to determine the opening cash and cash equivalent this year, I'll go to the balance sheet last year. I'll see there is a cash of 4 million and there is a fair value investment of 2 million. So my opening cash and cash equivalent will be how much? 6 million. Are you there? So when I'm preparing my cash flow statement here, I will start and say opening cash and cash equivalent 6 million, which is the cash of 4 million plus the short-term investment of 2 million. So in other words, we are trying to say any short-term investment among the current assets, by whatever name the examiner is calling it, always consider it to be a cash equivalent. When you are adding the cash and cash equivalent, take the money in the bank. There might be bank also. Don't forget, there could be balance in the bank. Let's assume 1 million. So cash and cash equivalent will comprise of this money in the bank, this short-term investment of 4 million, plus this this cash of bank of 1 million balance, cash of 4 million, and this short-term investment of 2 million. So you are opening cash and cash equivalent is 7 million. Are you there? So even bank is considered as part of cash equivalent because you can get money in your bank very fast. So I hope you have got now. Are you okay? Somebody called Namus. Somewhere. Are you okay now? For those who Somebody called himself administrator. Are you okay now how to treat short-term investments? I want to get an answer whether you are through, or somebody else tell me whether you have understood now. Good. That is also important, because some of your questions come with a short-term investment among the current assets. And I've said, don't forget, though it's like an investment, don't take it among the investing. Listen, though it's an investment, don't say it's an investing activity. It's true. You have a short-term investment amounting to 2 million last year, and this year 5 million. We could have bought some more short-term investments, but don't take it to the cash flow as part of investing. I told you investing activities are those transactions that affect fixed assets, or what we can call non-current assets. Otherwise, any short-term investment should be considered as a cash equivalent, just like the bank. Good. Thank you. I have no time to proceed from there. I want to stop there for today. Maybe next time we can develop the topic further before we do an example. There is yet more to be discussed in terms of how to compute some of the items and so on. So maybe for today, I can stop there. I pick it up from there next time. I pick it up from there next time. But before we leave, let me mention this. Before we leave, you could be among those who are watching me either through YouTube or through Zoom, and you have not joined our online classes. Listen, if you have not joined our online classes, or you have a friend who have not joined our online classes, tell them that we have online classes for the following subjects. 1, advanced financial reporting of the advanced level. We have online classes for that. Tell them we also have online classes for financial reporting of the intermediate level. Okay. We also have online classes for financial management of the intermediate level also. We also have financial management of the intermediate level, and financial accounting of the foundation level, and the one of ATD1 and ATD2, because they also have financial accounting. Those are the 4 papers we are currently offering online classes for. If you are here, or you have not joined our online classes, or you have a friend who would want to join online classes, tell them that we have those 4 subjects that we are offering our online classes for. 1, advanced financial reporting of the advanced level. 2, financial reporting of the intermediate level. Financial management of the intermediate level, and financial accounting of the foundation, and the one of ATD. Now listen, if they're not able to join the live class, or for whatever reason they can be missing some of the live classes, they can still buy what we call the pre-recorded videos. They can still buy what we call the pre-recorded videos, where they can watch the videos at their own free time, at their own pace, and whenever they have a question, they can call me anytime. I'll help them and explain. Okay, that is it. So if you have a friend or you who have not joined, then you can join now. Good. Now, if you want to reach me, you can call me on this number, 0722 65 8875. If you want to reach me, you can reach me on this number, 0722 65 8875. If you need the country code, that is 254 722 65 8875. Okay, we can discuss how much it will be the cost and the modalities of payment. If you want to pay in installments, that can be done. Good. So again, listen, again, some of you are watching me through YouTube and you have not subscribed to my YouTube channel. So if you are watching me through YouTube and you have not subscribed to my YouTube channel, please click that subscription button down there and subscribe. As you're watching me, you can even click that button right now and subscribe, so that you may be notified whenever we post new videos into the YouTube. Okay, there are some videos we have posted to YouTube for promotion purposes. Again, the name of our YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel. If you go there, you will find some of my YouTube videos there, which are there for promotion. They are not all, but They are there for promotion purposes. You can go there and watch some of them. I hope at least listen. I hope at least you have understood something, especially for those who are watching through YouTube. You can also click that like button. Click that like button. I hope you have understood something today. Click that like button and like the video. I hope you have understood something today. Good. So I don't have much to say for now. For those who are watching maybe through Zoom and maybe you have a comment, I hope you have understood something today. Somebody called Priska has already said yes. Thank you. Any other comment before we close the class? Somebody who has a comment, especially those who are watching through YouTube, through Zoom. Maybe you have a comment. I hope you have understood something today. I hope you have understood. Before we close the class, you can say yes. Yes. Somebody called EW amesema yes. Thank you. Well understood. Well understood. Thank you. If you have not joined, good night. Yes, thank you. If you have not joined the class, please call me on that number, which is 0722 65 8875, and we can talk more. Good night. Bye for now. Thank you. Okay. Bye.